I am going to share my screen. And if you guys are on mobile or laptop or wherever you are joining from, just go into this link, start typing, why are you here? Okay, so just let me share my screen. Raghav, can you just enable screen sharing? Okay. So let's do this. Okay. So can you guys see my screen?
Yeah.
Okay. So just log into Slido, enter this number, and start putting in your details in terms of what are you hoping to get out of the session. Okay. Okay, guidance. Anybody else? Guys, it would be helpful if all of you participate, and that way we will have a more productive session. I'm hoping that I'm able to help you out through some guidance and in terms of sharing my knowledge in terms of whatever I have done, and take things from there. Okay, guidance, startup growth phases. How much inventory is okay. Important aspects of pitch. Okay. Debt versus equity. Okay. Basics entrepreneurship. Okay. I think I've got enough details here. Now, of these points, some of the things that we will be covering will be more in terms of pitching. Now, that's the subject. Now, what we have to understand here is some of the aspects in terms of, let's say, basics of entrepreneurship or debt versus equity. That is very wide topic, and you can go, you can have your own sessions about these. But some of the aspects in terms of guidance regarding capital, important aspects of a pitch, how much inventory is.
Just a small suggestion. Maybe before we start, maybe you can introduce yourself and then where you're coming from.
I will.
Yeah.
So I'm just trying to gather data here. Okay. All right. So some of these points we will be covering today, but for some of the other points, maybe we will have another session and we'll talk about those later. Okay. Now, I'm just going to stop this and let me just quickly introduce myself. So my name is Amiya, and I've got about 15 years of experience in this industry. I've done different things from support to consulting. I've done product management for Cisco, Amazon. I've been running my company for the past 3 years. Also working on another startup concept right now. And at the same time, I'm a startup mentor with Vadvani Foundation. I'm a startup mentor with NASCOM as well. So that's a quick summary about myself. Okay, so let me get started with why we are here. So art of pitching. Now, what is this about? Of all the different topics that you had mentioned out there, some of the things that we are trying to cover are in terms of understanding the minds of the investors and their expectations. And from a pitch perspective, sorry, if you could just mute yourself, Priyanka, that would be great. And from a pitch perspective, what's important to understand is timing. That's very, very important. So you can't go ahead and pitch at any stage. You have to be ready. You have to understand certain things about certain variables that are there prevalent in the market, and then you have to prepare for a pitch. There are different kinds of pitches. We will talk about them. And we will talk about how to draft a compelling pitch. At the same time, we will talk about what are the different contents that we should put inside the pitch and how does it play in the mind of an investor. Okay. Now, before I start, I want to ask one more question. I'm going to go back to the slide. If you could just quick quiz, if you can go ahead and enter your details here. Okay. So this is the Q&A. Okay. Can you guys see my screen?
So Amiya, we're looking at what is it about? That's what we're looking at right now.
Are you able to see this?
Yeah, the what is it about?
Only the presentation, not the slide actually. Not the slider one, but.
Okay, I will try again. Can you see this? Is an investor also a customer?
No.
Okay, never mind. We'll go back to the presentation. But let's just talk about this. What do you think when we talk about an investor? Do you think that investor is a customer as well?
Yes.
Okay, how about others?
Yeah, I think you have to treat your investors as your customers.
Yes.
That's a very important point. And you have to remember this always. So when you're looking at an investor, you have to understand what is an investor, not who could be anybody, but what is an investor? An investor is someone who is a financial backer. That's our general takeaway. And that's something that we always try and bank on. But there is more to it. They are the risk takers. And they can come from diverse backgrounds. They could be your strategic partner as well. So it's not just about the money. When you're looking at investment, you're not just looking at the money. You're also trying to figure out where else can this particular investor help me out. They can have varied sort of investments within your startup as well. So it just doesn't have to be capital investment. It could be a strategic partnership. It could be a mentorship investment. It could be a networking connection investment. And you have to also understand that investors have certain preferences. What that means is that not every investor is fit for you. If your startup is into a certain sector, you have to do your research. You have to try and figure out who's that entity. An entity could be an angel investor or could be a VC, could be anybody. Who is this person who's going to take risk on you? And where are they coming from? Where have they done their investments in the past? So understanding your investor is equally important. Now, the reason I asked this question, do you think that investors are your customers as well? Because at a lot of times I've seen people being very circumspect about, should I tell an investor everything? Yes, you should. There is no point hiding anything from an investor. They're not going to take your idea, go ahead and make their own product about it. Okay. Even if they do, it's all about the execution. So you have to be very clear in terms of how transparently you are putting something out there in front of an investor. And at the same time, think about it from an investor's point of view. They are your customers. You're not going to go in front of your customer and say that, boss, this is my product, but I'm not going to talk about this feature. I'm not going to talk about how am I building X, how am I building Y, how am I doing operationally, etc., right? So you're not going to do that to your customer. Then why do that to an investor? So when you're looking at an investor, you should always treat them as a customer, be absolutely transparent with them. But at the same time, not everybody is your customer of your product. And similarly, not every investor is your customer as well. So you have to be very careful in terms of identifying which investors to choose for. And some of these criteria that I mentioned in this particular slide, you have to have that research done on an investor as well before you decide that you want to go ahead and pitch to them. Okay. So there is a lot of need and desperation that I see when we talk about different startups. They want the money, but they don't do a proper marriage sort of research in this term, right? So when you're onboarding an investor, you are practically married for the time being that the investor is there. So you're not going to go blindly into a marriage, right? So similarly, you have to be very careful about who you are choosing as an investor. Okay. Now, what interests an investor? That's the major question. Now, there is a acronym here, FUD. So FUD stands for fear, uncertainty, and doubt. Whatever you're putting in front of the investor, you have to make sure that the fear that the investor has, the uncertainties that are there as a part of this entire startup, and the doubt of the investor, these things are taken care of. What you need to do as a founder is go back to the drawing board and put on the hat of an investor first. Then look at the entire material, your entire startup, right from your product to how you're going to acquire your customers, how you're going to run your business, what are you going to do operationally, and then ask yourself, what are those points where someone could have an FUD? FUD is fear, uncertainty, and doubt. And once you have done that exercise, you have to come back to it and answer those questions for yourself first. Okay. Now, once you've done that exercise, what it really means is that you will know where your major pitfalls are, potentially speaking. And you will be better prepared to answer those questions, and you will have better prepared answers when you're getting in front of someone. That's the first thing that the investor is really looking for. Second thing is founders. See, at the end of the day, there are so many fresh founders out there. They have not done a past startup. They do not have a major MBA background, etc., where they have at least theoretically learned about things, if not built things. So investors, when you're looking at a fresh startup, they are actually backing on founders more than anything else. Okay. So think of it like a priority. FUD has to be minimum. Founder has to be decent enough for them to be able to trust you to be able to execute all of these things. Okay. The third thing that they are looking for is risk versus reward, meaning I put 1 rupee, I want 2 rupees. And that's where your investor research has to come into the picture. If you're looking at an investor, for example, if you're looking at a venture capital, let's say Sequoia Capital you're looking at, and you want to ask them for, say, 50 lakh rupees. 50 lakh is too small a ticket size for them. And what kind of return are you looking at for 50 lakh capital investment? So asking amount from an investor has to be sort of calibrated according to the risks that they take and the rewards that they are expecting. So an angel investor would probably be fit for a 5 lakh ticket size or a 10 lakh ticket size. But a VC is when you go up to at least $500,000 or $1 million and above. That's when you're looking at VCs. Okay. And you have to understand what sort of returns they have had, what sort of returns they are expecting. If you're looking at an angel investor who's investing at a ticket size of, say, 3 lakh rupees, they are probably expecting to make that a 10x in the next 2 years. Right? When you're looking at a VC, they are probably expecting a 100x return. Right? So they're very careful, and also understand this, that you are not the only startup who's out there who's reaching out to them. So while you may be confident within your startup, you may have a certain level of traction, you may have done a lot of different things to showcase that you are a good startup to invest in, but the person in front of you, they are meeting 5 startups every day. And out of those 5 startups, let's say over a period of 3 months, they have to select one. So it's not about your startup for them. It's also about where should I put my money so that I can actually get the reward that I am expecting. And all of those things, other things, FUDs, founders, etc., are taken care of. The other thing that the investors are really looking for is an exit. If you're looking at an angel investor, what do they want? They want an exit. At what stage? Maybe once you are looking at a seed stage or a series A, that's when they want to exit. And I'm using a lot of these terminologies and nomenclatures, but just think these are different stages of investment. So an angel investor could come in at a pre-seed level, which is essentially saying you have just built your product, you're looking to launch the product, etc., and they are investing 2 lakhs, 3 lakhs, 5 lakhs, etc. But when you're looking at a seed level, then they could potentially be looking, someone could potentially be looking at 10 lakhs, 20 lakhs, 50 lakhs of investment. When you go to series A, series B, series C, there are different rounds of investment. So when you're looking at series A, potentially you're looking at least 2 CR, 3 CR, 5 CR kind of ticket size minimum. And that's where your VCs come in, because angel investors typically tend to limit their range from say 2 lakhs to maybe a crore. But when you're looking at VCs, they are the ones who are investing these big bucks, 10 crore, 50 crore, 100 crore, 1,000 crore. That's when these VCs actually come in. VC is venture capital, by the way. Okay, so this is what an investor is really looking for. Okay, now timing. This is a very, very important thing. So you may be confident that, boss, I've built the product. Okay, I've got 100 customers on my product. There are 200 people who have told me that, hey, this is a great product. Everybody would love it. But this is a very small sample size. When you are putting your product out there in the market, you have got two factors. First factor is internal factor. Second factor is external factor. When you're looking at an internal factor, your readiness, let's say the company stage where you are, how many investors, different kinds of investors do you know? What sort of traction do you have? All of these things will come into the picture. But that's only one thing, one aspect of what an investor is really looking for. The other aspect is the market readiness, the competitors. A market readiness could also be your competitors out there. Who are you competing against? When you're thinking about competitors, most people tend to think in terms of direct competition, that, okay, I manufacture, let's say, electric vehicles. How many electric vehicles are there? But for someone who is into automobiles, what is it going to take for them to move into EV at some later point of time? Let's say you are doing something of, say, matrimony thing. For example, you're looking at shadi.com, you're looking at matrimony.com, etc., etc. But tomorrow, what's going to stop Aisle and Tinder and all those things to come into this picture, especially if they see that this market is going somewhere? Their target market originally is different, but it takes one entity to show that there is enough market, there is a certain readiness in the market, and then the entire game changes to market share. Okay, so you have to understand your product, your company, you have to build your network, you have to have a certain level of traction, and also understand how ready is your market, how ripe is your market, how many people are really out there thinking, I don't want this product, I need this product. Without this product, my life is incomplete. So when we talk about sort of a little bit of digress, when we talk about a product market fit, it's not so much about, well, whether people are using it, but it's as much about, do they really need it? If there is an alternative tomorrow, are they going to jump? What are the other alternatives available? You have to think about all these things when you are creating your pitch. Why? These are all the different things that will affect your FUD. When an investor is looking at your pitch deck and they want to talk about, okay, so what sort of traction do you have? You could come back and say that I haven't launched the product. Now, what does that do to the fear, uncertainty, and doubt? Raises it up. They say that, okay, there are 5 different competitors out there in the market. They've got so-and-so traction. How are you going to deal with them? What's your USP, etc., etc.? If you don't have a proper response, if you haven't done proper research, you're going to come back and answer to them something. But what it does eventually is raises the FUD. So all of these things combined together, that's what sort of constitutes how an investor is going to look at your pitch, more granularly. Okay, there could be other factors as well, but at a block level, major block level, these are the things that you should potentially be looking at to understand how you are going to prepare for your pitch. This is not even talking about the pitch yet. Preparing the pitch itself is a very heavy task, or pre-preparation rather, is a very heavy task. You have to put in a lot of time and research and understand your product, your company, your customers, your competitors, and then get out there to try and see whether you are now ready to draft a pitch. Okay. Types of pitches. There are 3 different types of pitches that we have. First is an elevator pitch, essentially to say that, let's say, one of the things that we mentioned was networking, right? You are at a networking event, you come across someone, you are in an elevator, you have maybe about 30 seconds of time. What are you going to say to incite some sort of curiousness within the person in front of you to say that, okay, let's meet? That's an elevator pitch. You need to have that kind of command over your own product, over your own company's details, so that when you put your 2 lines out there, someone should be able to say, okay, let's talk more. Okay, that's an elevator pitch essentially. Now, proper investor presentation pitch, which is what we typically think of a pitch as. It will have a lot of different components, entire details, so it's structured, it's comprehensive, and the focus of this particular pitch is to see if you can convert the particular investor. Okay, elevator pitch is mainly about strong first impression. The proper presentation pitch, it's mainly about conversion. You want to take that discussion to the next level. That's why you are doing this. And there is a third one as well. Now we talk about presentations, but what we don't talk about as much is giving demos. So you'll see a lot of pitches and you'll see screenshots and this and that and whatnot. But just restricting the number of slides on the PPT, but saying that, hey, can you go ahead, download this, or I'm going to download this, and within a screen share, if you are sitting face to face, just giving them the demo, the touch and feel of what we are doing here. That has another different level of impact. Okay, so you're talking about 3 levels of impact. First, get a first impression. Second, try and see if you can convert them. Third, make it memorable. Demo is to make it memorable. Whenever you're looking at anything, these are the 3 different approaches you potentially take depending on the situation surrounding people you are with. Okay, now crafting compelling pitches. There are 3 things that we have to really focus on. The first thing, storytelling. Now, we talk about the problem, we talk about the solution, we talk about a lot of different things, but how does it impact people? Are people going to relate to all of what you are doing? So your storytelling is extremely important. Let's say you look at something like Zomato or Swiggy, for example. You cook food, you eat food, but the story is that the way it started was, if you are a single guy, if you're not willing to cook, if you don't know how to cook, go ahead, order, we will give you something. Now it's more of a luxury choice. So there is a certain emotional connect. So if you look at some of these ads that these guys have, you will see that there is a certain story angle that they put in their marketing. And that's what storytelling with impact is all about. Okay, it engages your emotions, it highlights the problem and the solution. Now, the differentiator is another thing from an investor perspective, unique value proposition. How are you going to stand against the market forces, the external forces? That's also something that you have to very clearly highlight within a pitch. And if you have any sort of data, especially of your own product. So a lot of times we cite examples that this research showed this data, that research showed that data, etc., etc. But it's your product, your data that is actually going to drive the credibility. Why? Ideas are quite literally dime a dozen, but it's the execution. You may have the best idea, but when you start building a product, that's when you start realizing how difficult it is. And even more difficult is selling the product. So all of these things are purely execution based. You can have a lot of different strategies and you can talk about 2-year plan, 3-year plan, etc., etc. But within 3 months, if you're not able to do the sales, you are going to run out of money. Let's say you have a 1-year runway or 1-year sort of bandwidth to be able to spend the money. But if you're not selling, that 1 year is not going to be enough. So your data, what have you done? How many milestones you have been able to achieve? What sort of evidence you can provide? What sort of validation can you provide? How realistic is your financial projection? If you have already done any sales, what are those numbers? All of these things are some of the very, very important components of drafting or sort of incorporating into the pitch itself. Okay. So just these 3 things, if you can focus on, they will sort of reduce the FUD and drive up the credibility and confidence of the investor within your startup or within the founder itself. Okay. So from a pitch deck perspective, very standard content. See, we don't need a lot of information. It depends. Again, if you're looking at an elevator pitch, this pitch deck is irrelevant. It's just 2 minutes of time that you have to talk. You need to be ready for it. If you're looking at a demo, then your product needs to be ready to be at a certain stage for you to be able to showcase. This is all about the in-between part, where you are sitting in front of someone, giving them a virtual demonstration or virtual presentation, or sitting with someone face to face and talking about it. What they need to know, as crisp as possible, and that is great. You don't want a lot of information. You can have backup slides. If you feel that someone could ask for it, you can have a backup slide for it. But focus on problem, solution. What is the market opportunity? In the sense that if you are looking at a 10 crore market, for example, 10 crore market means what? Your maximum cap on what you can sell, it's 10 crore, for example. And you're saying that I will capture 1 crore out of it. That's not lucrative enough. You have to either pivot or show them pivot in the sense that you have to show them that, okay, before I reach 1 crore, I will be doing A, I'll be doing B, I'll be doing C. So essentially, I'm looking at a 500 crore market. Or you have to say that the market itself is 500 crore. I'm looking at 10 crores to start with, but I'm going to do A, B, and C to eventually keep increasing my market share. Okay. So market opportunity is extremely important. Unique value. It's one of those key slides that you have to really focus on. How are you going to differentiate yourself from everybody else out there, and while ensuring that your customers love you? Okay. Execution strategy, we feel a bit circumspect about sharing these things, but there is no problem, in my opinion, in sharing this with any investor for whatever reason. What that means is, what's your business plan? How are you going to make money? What's your go-to-market strategy? How are you going to do your marketing? What is your operational strategy? You can share all of these things. It doesn't have to be a part of the primary deck itself, but you can keep this ready as a backup slide, so that if someone asks, you can jump over to this slide and you can show them, okay, I'm going to do my GTM this way. This is my plan. These are my timelines, etc., etc. Okay. If you haven't launched the product, if you're not generating any revenue, then your finance and traction is projections only. But again, depending on the FUD, how much confidence an investor has, it depends. If you have done execution and if you have got some numbers, that adds a lot of credibility and confidence. Minimizes FUD, increases the credibility and confidence. Okay. Exit plan, very clearly, depending on the different stages that you're in. If you're looking at a 3 lakh investment, then they want to exit at 30 lakhs. So let's say you raise a couple of rounds, your valuation is now 10 CR, they would want to exit. If you've got a 10 CR investment, then they would potentially want to exit at 1,000 CR valuation. So exit plan, if you can put, if you have that clarity, good. If not, create something in your mind that if a particular investor is coming in at this stage, how do I get them an exit and at what stage? Okay. Team, this is extremely important. If you do not have any traction, then unique value and your team. These are very, very important slides. Problem solution, sure. Market opportunity, sure. But all of these are your understanding, your biases, your assumptions, your hypothesis. As a team, are you able to really execute on this? That is the question. So your credentials, where you are coming from, what sort of role have you played in the past? Have you done something like this before? Have you part-time, full-time, or even as in a supporting role? Have you dabbled with some of these things? It could be something as simple as handling the finances, handling the marketing, building the product, etc., etc. So collectively as a team, you have to cover all the bases and showcase to the investor that we are 3 or 4 people who are doing X, Y, and Z, and together we are looking at executing on this particular idea, solving this particular problem through this solution and delivering. Okay. They might even come back and tell you that maybe you do not have an operational guy, and you, because your business is operations heavy, you need someone. Be open to it. So you will have a little bit of back and forth, but you have to be sort of open to understanding what they are saying and assess for yourself. Does that really add value to you? Do you really need that? Does that make sense? Okay. So sort of take a stance according to what's coming your way. But team is extremely important to showcase. If you already have traction, then the assumption that I have is you already have the right people in place who are able to do the job properly so that you are able to generate revenue. Okay. And the last thing, and one of those questions were ask and the action. Now, ask is a very tricky thing. The reason I say that is, now think about it this way. Let's say you're building your product. It's a software application, for example. You haven't launched the product and you're thinking that I'll go out there in the market because my product is great. Someone is going to invest in me. Okay. But there is no valuation defined. There are a lot of different mechanisms out there. Okay. Typically, you will hear people say that any startup idea is worth, it could be $500,000. Okay. Minimum investment that, or minimum valuation that you start with. But these are all theoretical. And very clearly, I want you to understand this. Before any sort of revenue, anything you say, anything anybody else says, or any notions that are out there in the market, they are all assumptions and hypotheses. None of this is factual. If you are sitting in front of me and you say that we haven't launched the product, but we are thinking at a $500,000 valuation, I would say I'm looking at your presentation and I don't see it being worth $50,000 right now. Now, either you're going to argue and fight about it, but that doesn't leave you anywhere. So finding the right investor who sees you as a $500,000 worth of valuation is as important as saying why you are $500,000. All right. Similarly, let's take another example. You have valuation, you have some revenue, you are generating certain income, you have some, potentially speaking, net profit, net loss, it could be whatever, but you could have certain valuation. In that particular case, you know what your 1% equity is worth. And that's an actual data. That's not arguable anymore. Okay. But when you are starting up, let's say you have just launched the product, it's been 3 months in the market, and you have, say, 1 crore of revenue. By that standard, I'm saying, let's say my 1% equity is worth 1 crore. Okay. So for 5 crores, I could be looking at 5 crore, 5% equity, I could be looking at 5 crores of investment. But if I don't raise that investment and continue building further, continue investing further, keep it bootstrapped, and say that now my company's valuation is, say, 1,000 crore. Okay. And again, these are all very theoretical, but I want you to understand the different stages where you could potentially be thinking about investment. So if my company's valuation is at 1,000 crore, my 1% equity is going to be 10 CR. So 5% equity is going to be 50 CR. So the question that you need to ask is one of those questions that we had in terms of what people want to learn more about. How much should I raise? When should I raise? these are all totally up to you, because if I have 5 lakh rupees in my bank account, for example, and I see that to survive for the next 6 months, I need 15 lakh rupees, then I need to go out to someone and raise a certain amount to be able to survive in the first place. So it's not about my product, it's not about my business anymore. It's about survival. A lot of times we raise because we want to survive in the market in the first place. If you can be slow, be consistent, but add value, then might as well just remain bootstrapped. If you see that, okay, now I've reached a 1,000 crore valuation and I have a certain brand name, but now I need to start a different branch altogether, which is going to need 1,000 crore capital. Then it makes sense for me to sort of go ahead and ask someone for 1,000 crore amount and raise that amount. So it's not a very straightforward thing to say that when should you raise and how much should you raise. You need to understand why you need to raise. You need to understand that for the money that you're taking, what are you giving? And are you okay to give that amount? If I have to raise 50 lakh rupees and someone says that I want 50% of your company, I have to think for myself whether I'm okay giving 50% of my company for 50 lakh rupees or not. It doesn't matter about the valuation and all those things. So you are sitting at a negotiation table. It's not, there's no, honestly, there is no science behind it. There is DCF mechanism. Someone asked about debt versus equity. Sure, there is CCD, there is equity, there is SAFE, there are a lot of different instruments. But none of these instruments are going to answer these questions for you. Why are you raising? Is it about survival? Is it about validating your product? If you're thinking that you will raise and validate your product, sure, you could do that. But at that particular point of time, your 1% equity is probably worth 1 lakh rupees. Whereas if you validate on your own and you start generating revenue, then your 1% equity is probably worth 1 CR now. So you have to ask yourself, what is the worth that you are putting behind your 1% equity? Okay. I think that concludes the presentation. So if you have any questions, I'm open to answering them as well.
I have a question, Amiya.
Sure.
Now, we have two kinds of companies, right? Startup, the private company or the LLP. Now, with LLP, I was told that there will be no equities, but it's only the debt that we have to raise the investments from. Now, if we raise the investments, through the debt, what is the overall? I don't know how to say, but would that be ideal for any LLP to survive? When we actually take that kind of debt, because sometimes it can be more, sometimes it can be less, but depending on how we convince the investors, do you think that that would still be achievable?
See, at the end of the day, let's break down your question into two components. One, why are you looking to raise? And second, three questions. Second, who are you looking to raise from? How much are you looking to raise? Okay. Now, your question majorly is inclined towards understanding, should we, can we?
Yes.
Right. But there is a precursor to this, in the sense, why? Okay. Now, if you're not talking about survivability, if you're saying that, okay, yeah, I'm generating revenue, I'm doing XYZ things, but I want to do something at a faster speed. So it's a speed versus survivability thing. Okay. In that case, it's your choice. But if you're looking at answering the second part of the question, that can you? Sure, you can. But typically, when you look at VCs, big venture capitals, okay, or even some of the medium ones, they don't typically take interest in LLPs. Your company needs to be a private limited company for them to be able to invest, because that's when the equity comes into the picture. And it's all about the game of equity. Okay. You can raise debt, sure. But it also depends on how much confidence do you have will you be able to repay? Because at the end of the day, someone is going to be held liable. You see my point? So it's not a straightforward thing to say, can you or should you? Can you? Yes. But you have to find that person who will be willing to invest in an LLP. And in my experience, that's rather rare. You don't have a lot of people who are willing to invest in an LLP. They generally ask that your company needs to be a private limited company. Okay. Finding that person is extremely important. How much are you raising again? So if you're raising debt and you're trying to raise 100 CR amount, then if your business says that, okay, I'm raising 100 CR at a, let's say 5%, 6%, 8% interest, will I be able to repay? How much of repay amount that I will incur? What is the duration and all of those things? So your financial and accounting systems have to sort of churn out those numbers, and your revenue, some sort of incoming has to be there for you to be able to say that, okay, yeah, I can raise at this much amount at so much interest and then be able to repay it, right? So it's more of a math problem, but understanding the why, that's more of a business problem. You see the difference?
Yeah. Got it. Yeah. Got it.
So yeah, I mean, in a nutshell, there's no straightforward answer. It all depends on what do you want, why do you want it, and will you be able to handle it? In the sense that 2 years down the line, you could have a investor who has invested in a private limited company and be willing to exit, and you could go out there and say that, look, in the past 2 years I've done this, and raise another round and give an exit to the investor. But if someone invests in an LLP, you may want to go out there, find someone who's willing to invest 10x the same amount, but they don't want to invest in an LLP. What do you do then? Right. So there are a lot of different variables.
Okay. So does this mean that the LLPs are trying to play safe, and that is something that the VCs would not be actually gone with, or going on hands with, as we said, there should be a marriage between an investor and the company. So that doesn't happen with LLP.
No. And again, I mean, I don't want to explicitly say no, because there might be someone who would be willing to do it. I haven't seen anybody who has invested in an LLP, and I am part of few venture capital groups and circles and all of those things, but I haven't seen anybody investing in an LLP, to be honest with you. So, but I want to sort of keep that reservation that yes, there could be someone out there. I don't know them.
Thanks, Amiya.
No problem. Okay. I see Piyush has got a question. Go ahead, Piyush.
Yeah, Amiya. So I'm currently working with a startup, very early stage startup. It's into HR tech space. Really, they are building a platform, B2B platform for evaluations. So for the screening part of candidates, they're building assessments and evaluations kind of a product. So just want to understand how can I derive the TAM SAM SOM for them.
Sorry, Piyush, your voice is breaking up. I didn't hear your question beyond the TAM SAM SOM.
Just a minute. Am I audible now?
Yes.
Yeah, so I'm saying that I'm currently working with a startup who is building a very early stage. So they have this product around evaluation and assessments. HR tech product, which will help companies to evaluate the candidates for their assessments, tech and non-tech assessments. So I want to understand how can I calculate the TAM SAM SOM for them.
Okay. TAM SAM SOM is sort of falling into the market opportunity section, but
yes.
Let me answer this question in two parts. Okay. The first part is to say that why TAM SAM SOM? Why? You are essentially trying to understand what's the market opportunity. Okay.
Yes.
I will introduce another concept called serviceable leadable market. Okay. Look into that. And that's a very viable option to TAM SAM SOM. Now, TAM SAM SOM, the problem is that it's highly theoretical. Okay. Let's say you are into HR tech. Now, you define a lot of constraints first to say that, okay, I'm looking at India geography, I'm looking at tier 1 city geography, I'm looking at XYZ things, and then this is my total market. Now, this total market has to be based on indirect research data that you will be citing from somewhere. Okay. Sorry. So you're not doing your first-hand research anywhere. What that means is, let's say I'm trying to do valuations for candidates in a for whatever company. There are, let's say, 10,000 companies, and basis that they spend so much capital in trying to do something and XYZ. So build your own logic, do your own research, and that's where you get a TAM. And again, TAM would not just be about the value.
Sorry, your voice is breaking in between.
So I'm saying, when you're looking at TAM, are you able to hear me?
Yes.
Okay. When you're looking at TAM, you're looking at the total HR market. That's the total addressable market for you. Right?
So
when you're looking at the segment,
my TAM will be the SaaS part of the HR, or the overall HR tech market.
It depends on how you want to define things. See, that's why TAM SAM is extremely tricky. There is no right way of doing this. So if you okay, I don't have a counter to that, because that's theoretical, absolutely theoretical.
Okay.
Whether you will ever get there, I don't know. And when I say ever, I mean ever. Okay, there is a very likelihood that your company might exit, you might reach an IPO, you might do whatever, but you will never hit your TAM. So it's theoretical, and in theory, you can write whatever you want to do.
Okay. And what is the other term that you have used apart from TAM SAM?
It's called SLM.
SLM.
Okay, and that is relatively more specific. It's to say that, what are you doing right now? Okay, you are building this thing, doing this valuation in HR. Okay, what your SOM was, that's your SLM level 1.
Okay.
You start from there. Instead of saying that there is a theoretical market out there, I'm starting at what I'm doing right now.
Okay.
What is my market for that? That's a much easier thing to do. Then you can say that, okay, after SLM1, there could be SLM2, SLM3, SLM4, and that way you could potentially show how to expand your market opportunity further.
Okay.
So I personally prefer SLM model. TAM SAM is just way too theoretical for me to be comfortable with.
Okay, got it. Thank you.
No problem. Okay, John, go ahead, please.
Yeah, so am I audible? Is it
yes, you are.
Is the background noise too much? Yeah, thank you. So, I have one doubt. So, with the pitching and all, I'm fine. But how to initially approach an investor for a pitch? How to interest them in a pitch? How to reach them out? What words would exactly make the investor to see my pitch, or listen to what I say? How will we do that, sir?
That's step 2. First thing you have to figure out is, where are these investors? Okay, for your own company. So networking, when I say timing is everything, networking is a huge component of it. You have to be at the right places, be in front of the right people, and you have to define the right for yourself. Who is right? What is right? Okay, I could give you a number of networking events, but those networking events might not have the right kind of audience for you, right kind of investors for you. So be a stalker. Okay, not in a bad way, but be a stalker.
I get it, sir.
I'll give you a rough roadmap of how to do it. Okay, go to LinkedIn.
Yes, sir.
Go to different platforms and try and see who is that person who has got a track record of investing in companies similar to yours. Okay, now start stalking them. Okay, see where are they going, see what they are doing. You be there, you do that.
Okay, and also I currently have the database of over 300 plus investors. I have the email addresses, but I don't know how to draft the email for them. I don't know how to use the right keywords to make them see it, because for an investor, he'll definitely receive thousands of emails for each and every day. But
yes.
How to make him open exactly my email?
But that's a cold email thing that you have to sort of figure out a way to learn. Okay. There are a lot of different examples. You go to YouTube, you go to Google, you go to LinkedIn. There are a lot of people posting a lot of different things about how to do cold email marketing. This is essentially marketing. You are sending out, hundreds of cold emails in anticipation that someone will open it and give you a chance. I prefer a more warm method, which is essentially to say that I meet them face to face, I meet them virtually, and I talk to them. I don't see, if you get into a sales cycle first up without even establishing any rapport, that's a very difficult thing for anybody to convert to or even listen to you. First thing I need to do is I need to understand who this person is, what do they want, and understand this this is a very important thing to understand rather. The other person you're talking about is a human being as well, right? They have got their aspirations, they have got their needs, demands, desires, fears, etc., etc. If your email, and specifically with respect to your cold email, if you're able to tap into what their fears are, what their ambitions are, and have your subject sort of reflect that, then they are more likely to open it. But then it's a lot of research. It's a very niche thing to do. I'm not an expert of that, to be honest. I don't do cold emailing. I'm more of a warm person. I try and get an introduction to different people. If I know who I want to talk to, I would try and get an introduction to that person and talk to them. Don't need to sell it to them. Just have a conversation, try and figure out what do they do, are they open to something, and then have a next level conversation after that. Okay, so in my mind, warm works better. Not to say that cold doesn't work. Yes, it does. But then it's a very niche industry. You have to be really good at it to be able to get someone to open a cold email and be interested.
Yeah, sir. And sorry. So, can I make my 2-minute elevation speech in like elevation pitch through my email? Like, can I make it out?
You can, but then if someone doesn't open your email itself, content doesn't matter.
Yeah, and then exactly in a 2-minute pitch, what all the topics should I cover? Like, what category should I pitch to my investor?
So, elevator pitch, it's so not about the topic. It's think about it as a marketing for your startup. It's a 2-line thing. It's
like
quite
exactly
literally.
what should it? Yeah, sir.
It's not about. See, it's very difficult to say what you will put in there, because, okay, let's just take an example. So let's take which company has got connecting people or something like that. Let's take Nokia, for example, connecting people. If I remember correctly, that's their tagline. If not, whichever company it is. If they have to send a mail or an elevator pitch, they will start with just 2 lines. I've got a proposition which gives you a solution for people to be able to connect to everybody at any point of time, no matter where they are. That's my elevator pitch.
Okay, it's like basically a tagline for my business.
What do you do? It has to be interesting enough for the other person to say that sounds interesting. Okay, you can't leave it at a place that I'm doing this. So what? What does it mean to me? What does it mean to the people? What does it mean as a business? What does it mean in a lot of different variable ways? Okay.
Got it, sir.
It is very niche. At the same time, it requires a lot of skill. So you can write a 5-pager document and then drill it down to a 1-pager and then drill it down to 2 lines. And that's how you're potentially going to get there. The absolute crux of what you are doing is your elevator pitch. Absolute crux.
Got it, sir. And what about an exit plan, sir? So for an entrepreneur, for a first generation entrepreneur who is entering the business just now and is looking out for investment, he has no knowledge about the business jargons and so and so. Like, how would you draft his exit plan for an investor who comes in? What would be the steps?
See, exit plan is for the investor, not for the founder. Okay. If you are founding a business and see, there's nothing wrong with it, even if it is for a founder. You could potentially, pitch to an investor and say, within 2 years, I'm planning to exit this company and give it to someone else, and I'm going to sell it in XYZ ways. These are my potential target companies. That's very valid. And that means that investor knows that if I'm investing 3 lakh rupees right now, if you are going to sell it in 2 years to, let's say you are a mobile phone company, okay, and you say that, hey, I've just started manufacturing, in 2 years time I'm looking to sell this entire manufacturing and so whatever my assets and liabilities are, I'm going to sell it to Jio and I'm going to exit. Right now my cost to capital was, let's say, 100 crore rupees, but in 2 years time I'm going to sell at 1,000 crore valuation, and then I'm going to take an exit. Okay, so investor who invests, let's say, 1 CR right now is potentially looking at 10 CR in 2 years. So that's the story that you have to put in the exit plan. You could do that to say that my company itself is going to exit, or you could tell an investor that right now, if my valuation is 100 CR, you're investing 1 CR. In 2 years down the line, I'm going to raise 1,000 CR, and at that time, I'm going to give you a 10x exit. Okay, so these are two ways that you could potentially show an exit to the investor.
Okay, so I got that. And when an investor comes in, like, what would be the, like, how would we calculate the equity share? Like, how many, like, how can we, what would be the best way to, like, make the, calculate the equity cost? Like, for example, about the shares, like, how much share would it be, like, we should be focused about in giving the investors as well as for ourselves?
That's again very negotiable thing. There is no hard and fast rule. Okay.
So, like, which would be in the safe side?
What is safe side? And for whom?
I mean, like, yeah, for a founder, like, initially for some investors who would try to acquire a major share of major.
Sorry.
I'm sorry. So, like, yeah. So, when an investor, some investors, when they come in, I see them like acquiring major shares of the business, allowing only a few shares of investors to be retained by the founder.
Right.
Which initially would be I say I can put it out in a way like it's not safe for the founder, because initially, even if the founder, like, he's the sole owner of the firm, the major of the decisions should be taken by the investor, and he would have the major hold in the business. So it would be like we won't have the initial.
No, I disagree. The reason I'm saying this is because the founder is the one who took that cash, right? Who gave that equity. So if it was a bad deal for the founder, why did they do it? So it's your desperation and your need that is deciding what you are doing. How is the investor to be blamed for this? If you're not happy with investor one who's saying, I want 50% of the company, then drop him. Move into the next one who says, I want 5%. Wait for it. Or grow your company to that level where you are only diluting 5% of the company. So investors, think about it. Investors are there to look out for an opportunity, just like you are looking for an opportunity. Right? That's why you have to understand the investor persona as well as your customer persona. Right? And if you're saying that the founders are not able to make decisions, they're not able to do this, they've got this and that and whatnot, it's the founders who took the decision in the first place, no? Why did they do it?
I get it.
So it's at all times, it's you, it's the founder who's taking all the decisions. It's you. If you don't understand yourself, your business, your product, your customers, your market, your competitors, you are the one who's going to suffer. Okay. Investors, they know what they are. When I say they know, most of them, but a lot of times, if the market is not familiar, if the person who's doing it for the first time, for the 5th time, 10th time, they're not comfortable, they are not mature enough, you will see problems there as well. So it's not always to say that investors are right. Okay. Investors could be horribly wrong as well. But the decision at all times remains yours. You choose. You don't want their money? Say no. You don't want to dilute 10% of the company for 50 lakhs? Say no. Nobody's stopping you.
Okay, sir.
So accountability, ownership of your entire startup is with you. It does not lie with anybody else. If you think that the investor is aggressive, they are more dominating, you put it in a contract, you tell them face to face. As transparent, as clear you are in your communication is always going to be helpful and beneficial for you. You tell them, I don't want you controlling any aspect of my business. If you're comfortable, invest. If you don't, please leave.
Got it, sir. And in like last doubt, so in detailed pitch deck presentation, what would what would be like these slides should be in, like, that, like, is there a count, like within only there should be these many slides explaining these topics alone, or like we can go with the detailed presentation?
You can go with whatever you want to do. But at the same time, I would say pitch deck is not for you to put everything you know out there. It has to be very tailored and critical in order to take care of fear, uncertainty, and doubt that an investor has. If they don't know what problem you're solving, that's a lot of doubt and uncertainty. If your solution is not clear enough to them, that's doubt and uncertainty. If the market opportunities is not clear to them, that's a lot of fear. If your unique values says that they don't get the confidence that you will be able to compete, that's a problem. If your team, they're not confident about your team itself, that's a problem, right? So everything that you're putting, you can put however many, you can put a 50 slide, you can write a book about it. But the investor is not going to have the time, energy, or patience to look at all of that information. They are looking at the major content just as and remember, this is the first touch point. This by no way means that they are invested, they are going to invest or anything like that. It's just to say that, okay, this sounds interesting. That's all you're going to get out of this. What happens next is your CTA. You have to sit with them and follow up with them. Maybe over the same day, they will respond and say that, boss, let's talk about the next step. Maybe 3 months down the line, they will respond and say that, okay, let's talk about the next level. Let's say you have given someone a pitch, 1 year you are executing, you start showing results, they keep track of you without you knowing. Okay, 1 year down the line, they could say that, okay, now let's talk about it. So there is nothing saying that the time frame or timeline or whatever. And your content also, it has to be very crisp, reduce the FUD. Your pitch deck is all about reducing the FUD. It's not about you just putting everything you know out there.
Got it, sir. And would it be best if I use most of technical jargons in the pitch deck? Is it mandatory to use technical jargons in the pitch deck?
It's not. It's not. See, at the end of the day, again, going back to the first or second slide that I had, if you understand your investor, right, you have to understand that they are risk takers. Risk takers are mainly about business. Nobody's going to take a risk. I mean, nobody's bothered about whether AI is doing XYZ things or not. What business are you able to make of AI? That's the thing that interests them. Okay. Investors are putting their money, and for that money, they want money. So you can have your own technical slide as a backup. And if there is a technical representative from the investor team, you could talk to them about technical aspects of things. But bottom line that remains, if I'm investing 1 rupee, I want 10 rupees out of it. Can you do it?
Thank you, sir. I got it.
Okay, great. Any other questions? Okay. If there
Amiya,
are...
somebody was asking about whether this presentation that you've shared would be available offline, like a link or something.
I can share it. Sure. No problem.
All right. Great.
It was me, actually.
Okay. Sure, Piyush. Oh, was it John?
Yes, it was. Yeah.
Okay. Okay. Got it. I can share it. No problem at all.
Thank you, sir.
Okay. All right, guys. If that's about it, thank you so much for joining in. And you should have my coordinates in terms of LinkedIn, etc. You can connect with me. If you have any questions, please do reach out.
Can you please drop in your LinkedIn ID here in chat so that we all
It's
can
there
connect with you?
it's there in the link, meetup link.
Oh, okay, I got it, sir.
Okay. There is one more question. I think Priyanka has sent a question saying how to decide on co-founders if I am a solopreneur. Okay. Probably this is the last question. So Priyanka, the thing is, when you look at your co-founders, think of them as your customers. Okay. Everybody, if you're a solopreneur, especially, everybody's your customer. Do you want a bad customer? No. What is a bad customer? You have to decide. Similarly, when you are looking at a co-founder as well, you have to sit down for yourself and think about what skills you have, what skills are missing in your company, and think about it from a bigger picture perspective. You are looking at 2 years down the line, think you are a $10 million valuation company. If you have to run this business, what do you need? And from that perspective, who do you need to onboard? and you have to be absolutely ruthless about it. And there is no two ways when you're thinking about this, right? You cannot for 1 minute be in dilemma or doubt and say that, okay, this person looks all right, so I should be considering this person. No. If there is a hint of doubt, ignore. Be patient, wait, keep looking. There is no right way to do something, but when you're running a business, run a business. It's not charity, it's not friendship, it's nothing, it's a business. Okay? Be very confident and careful, especially when you are talking, when you're looking to bring someone on board as a co-founder. Have your terms and conditions, financial terms and conditions, work terms and conditions absolutely clear. And then sort of when you're looking at, I'll also say this, that when you're looking at disbursing this equity, right, be very open about it, that day one, I'm not going to give you anything. And I'm not a fan of giving anybody anything day one. You have to prove your mettle to be able to sort of stick, especially if you don't know someone. Okay. If you know someone, okay, then it's your personal relationship quotient as well into the mix. But if you don't know someone, there is absolutely no point in telling someone that day one, I'm going to give you 50%. 4 years down the line, within 4 years, you will be getting, 5%, 10%, 15%, 20%, and that way it will be what, whatever, 40% or whatever. That makes more sense. But building that confidence is up to you. Be ruthless, absolutely ruthless. Here for friendship. I hope that answers your question. Okay, so guys, if got it. Okay. All right, so if that's about it, thank you so much for you guys. My LinkedIn profile should be in the link itself.
And I just want to say thanks everyone for joining. And Amiya is, you can see that he's got a lot of experience in this area, and he's got a lot of things to share. And we will continue to host more workshops based on Amiya's interest and also you guys' interest. So if you have any specific topics of interest, then please do share your request in the Telegram group. I've actually created a link for you guys to suggest future workshop topics. So if you can, I'll post it again. So if you can fill that out and then share specific topics that you want to get some guidance on, that'll be very helpful for future workshops.
Okay. Thank you so much, Raghav, for giving me this opportunity. I'm posting my LinkedIn into chat. And if there's anything, guys, please reach out. Thank you so much for your time. And it was a pleasure having all of you here. Thank you for listening to me.
Thank you. Thank you.
All right. Thanks, guys. Bye.
Thank you, sir. The pleasure is ours knowing more from you.
My pleasure. My pleasure, Edward. Thank you. Bye-bye.
Thank you, sir. Bye, sir.
Amiya, maybe we can stop the recording now and we can leave.
Yeah, absolutely. Absolutely.
Thanks, Ben.
Thanks.
Yeah.